Ladies and gentlemen, boy, have things gotten much worse in the past 3 weeks since I've been away. That's right, in just 3 weeks, things have gotten from bad to completely dire. And in today's video, I'm going to be going over all the action, all the economic developments that have happened over the past few weeks. I'm going to quickly summarize it in this short video. And I'm also going to go over why I've been away, where I've been the past few weeks, because things are getting very serious. I've been in a bit of a dark space for the past 3 weeks, but again, most people just here for the content. They don't really care about me. So let's not waste any time, everyone. Let's get straight into the news, the facts, and the data. Okay, now this is going to be a raw, uncut video. So let's go ahead and go to some of the headlines I'm seeing here. So look at this, everyone. First thing that people need to know what is happening right now is something called stagflation. Look at this. Stagflation danger sees World Bank cut global growth outlook. Now, again, for those that don't know what stagflation is, what that is high inflation and weak economic growth. Now, the US already had negative GDP for the first quarter of this year. So it is very likely that we're already in a recession. But here's what you need to know. I don't care if they say we have 1% positive GDP growth during this next quarter, because in real terms, that's just numbers. That's just numbers on a screen. That's just statistics. But when you look at it in real terms, with inflation that has just come out, we got this new record inflation data that just came out today. I'll go over that later in the video. In real terms, things are much worse, because even if we do avoid a technical recession and we have 1% positive GDP growth the next quarter, with inflation's close to 9%, in real terms the economy is actually going backwards by 8%. Not only this, but wages aren't keeping up with inflation. Wages are going up around 5%, but with inflation CPI at 9%, again, people are going backwards. It doesn't matter if we're in a recession or not. For the average middle class American, it does feel like a recession, and this is happening globally. I'll also go over in a moment what's happening in Australia, because we've had some huge developments in Australia over the past few weeks. So that's just the first thing of many right now. A lot of the banks are admitting that there's going to be lower and lower growth. Now, what have I been warning about, everyone? I've been warning that the S&P 500 is going to fall 20 or 30%. Now, we're almost there for the S&P 500. Today the stock market absolutely plummeted over 2.5% or nearly 3%. I'll go over that in a moment. I said cryptocurrency was going to fall. I said Bitcoin was going to go to around 25,000. Which it did. It did have a slight recovery to 30,000, but it's showing more weakness. And I said I wouldn't be surprised if it goes to 20,000. And I also said the 10-year US Treasury yield was going to go above 3%, which it has. But the prediction I made that hasn't come true yet, but it is going to come true, is the housing market crash. And we have just got some new huge data to show us what is happening in the housing market. Because people, it's just a matter of when, not if, the housing market crashes. Listen to this, everyone. Mortgage demand falls to lowest levels in 22 years amid rising rates and slowing home sales. So this is just one of the first signs that the housing market crash is starting to begin. Now, the housing market, unlike the stock market, is very slow to react. And remember, the US is a very big market, so while some parts of the country could be falling, other parts of the country could be rising. I'm not saying it's going to be a blanket decline of 20% across the whole country in every suburb. You always have to research your suburb to see exactly what is going to happen in your area. But with housing so unaffordable, with yields at all-time lows, and now with rising interest rates, it's looking very unattractive to investors, and simply home buyers aren't going to be able to afford this, and the housing market is going to have to correct. It's just simple economics. Now, if interest rates go to 3%, say the federal funds rate goes to 3%, mortgage rates go to 6-7%, I think the housing market could easily decline 20%. And it all depends on how far the Federal Reserve will go to bring inflation down, which I'll go over more later in the video, because they have to go much higher than they're saying of 2 or 3%. There's no way they're going to be able to stop double-digit inflation with a federal funds rate of 3%. So this crash that we're all seeing right now could just be the beginning. And Wall Street is finally starting to admit it. Or could they be engineering this crash? Look at this. Jamie Dimon says, brace yourself for an economic hurricane caused by Fed and the Ukraine war. And how this is going to be caused by the Federal Reserve? Well, what made the markets boom in 2020 and 2021? It was quantitative easing. It was the money printing. It was buying all these assets on the Federal Reserve's balance sheet. But now they're doing the opposite. And you know what they say? Don't fight the Fed on the way up. You don't want to fight the Fed on the way down. And this month, they're going to be having a meeting next week, and they'll be announcing they're going to actually be doing QT and selling the assets on their balance sheet. And they've got a $9 trillion balance sheet. So they're going to have to keep selling those bonds, and that's going to make interest rates skyrocket. That's going to make margin debt more expensive. Stocks are going to have to fall, and interest rates for mortgages when they sell their mortgage-backed securities are going to go up as well. Now, of course, they're using the war for an excuse for all this inflation, which, yes, is definitely adding to the problem. But we've had this inflation problem for the past 18 months, much before the war happened. And it was because of the Cantillon effect. You increase the money supply and the cost of goods go up. More money chasing less and less goods, the prices have to go up, people. And what he's warning is he could see oil go to $150 to $175 a barrel. And I don't know about you, but oil has actually come down, but I'm seeing petrol prices, or what you call in the US gas prices, at all-time highs. And we haven't even reached $140 a barrel, what they were a few months ago. Also, the most dovish central bank of all, the ECB, the European Central Bank, finally signals a rate lift and eyes bigger moves in September. Now, the European Central Bank has been far behind the curve. They've still actually been doing quantitative easing. They've refused to lift interest rates. They were saying, don't worry, we're not going to lift interest rates for years. We're still going to be doing quantitative easing. Well, now inflation is far too high for them to ignore, and they don't want to do it, but they have no choice but to start lifting interest rates. And I wouldn't be surprised if they start doing 50 basis point hikes. And remember, they've been in the negative, so they're going to go positive. And unfortunately, with what's going on with Russia and Ukraine and what's going on with the gas crisis, the energy crisis in Europe, they are going to head into a deep recession. This is going to have big consequences for the whole world. And people, we are facing a deep global recession, which I'll get into deeper later in the video. Because look at this, record UK diesel jumps above €2, should I say, a litre on nation's motorways. And again, we're seeing this across the US. I think I've seen in California, gas prices are reaching $7 a gallon. The national average is now over $5 a gallon and is going to get much worse. And what's happening? We're seeing a cost of living crisis. All people's money now is going on groceries, energy, and petrol and gas. They simply aren't going to be able to afford the discretionary items. You're not going to see all this luxury spending, all this apparel spending, electronics. This is going to cause companies that aren't consumer staples on the stock market, their stock values are going to plummet, like what we've been seeing. We've been seeing Target, putting out very weak sales. And you know what I've been seeing is I've been going to the shopping malls and I'm seeing huge discounts. I actually went to get something from the mall, from a baby store the other day, and I could actually buy 2 items cheaper than what it was for the 1 item. And the reason for that is companies' inventories, they increase their inventory so much because of the shortages. Now they have oversupply in their inventories because they thought, with all the stimulus spending, with all these stimulus checks, the people keep spending. Well, now people don't have money to spend, the inventories are too high, and they're having to heavily discount to get rid of this excess inventory. And this is going to make companies' earnings fall dramatically and their profitability fall dramatically. Now, something that's absolutely huge that is happening. Remember last year, I was warning about the Evergrande crisis, where we're seeing a developer crisis in China. And I was saying, you better want to check your developers in Australia, for example, or the US to make sure they have no links to China. Because I think we're going to see a developer and a builder crisis like what's happening with Evergrande across the world. And people, it is starting to happen. We've just got an example here in Australia of the biggest home builder. They are in deep trouble right now. Look at this. New South Wales is racing to save Metricon from collapse. The New South Wales government is racing to prepare a bailout package for Metricon as a troubled builder teeters on bankruptcy, according to a new report. But of course, they're saying, look, this is just rumors. There's nothing to worry about. Metricon's strong. And again, people, that is the biggest home builder in Australia. I'm sure this is going to start happening with the US, because what happened is people would sign a contract to build a home a year or 2 years before the home was built. They would get the price fixed. And, normally when prices are only going up 3-5%, it's not a big problem for the builder. But people got to sign a contract, fix the price for a year or 2 years, and now the builder is building a loss because all these material costs are absolutely skyrocketing, and builders having to tear up contracts, or they're having to tell the client they have to pay an extra $50,000. And unfortunately, it's really a lose-lose situation. Either the builder goes bust, or the customers lose their deposits or have to fork out an extra 10, 20, 30, $50,000 to keep the bill going. But you know what's funny? Of course, the government is saying, look, they're too big to fail. We have to bail them out. Well, it seems like everyone's too big to fail now. They're having to bail out. First, it was the banks. Then it was these huge corporations. Now it's the builders. Everyone, has to be saved. Everyone, has to get attributed. There can be no losers in this economy. And really what it is it's socialism for the mega corporations. A lot of governments say, look, we don't want socialism. We don't want UBI. But they're giving socialism to these mega corporations already. Remember, people, there is no such thing as too big to fail. It is all a scam the government is trying to tell you to bail out their friends, their corporate colleagues. They give these huge donations to their campaigns. If this builder fails, yes, it'll be paying for that builder. Yes, it'll be paying for the customers. But guess what? A new company will come. They'll be more efficient. They'll take less risk. And the economy will be more efficient and more productive. You keep rewarding these companies with a bailout for bad behavior, guess what? They're going to keep on taking more and more risk, and there's going to be more pain, and the bubble is going to get bigger. Now, also some more data to show how bad things are getting. Look at this, everyone. Look at this. This is the US personal savings rate. We can see here it absolutely skyrocketed with all the stimulus checks in 2020 at 33%. But now, look, because of inflation, the savings rate has absolutely plummeted to just 4.4%. And eventually, people's savings are going to be wiped out. We're seeing debt is already at all-time highs, which I'll get into in a moment, and this is going to lead to a recession, people. Look, we can see here the average has been around 7% and is absolutely plummeting. This inflation is draining people's bank accounts, and soon it is going to hit zero. Look at this US index of consumer sentiment. You want more proof that we're in a recession? Look at this. Consumer sentiment is at an all-time low at just 58. Consumers are not spending, they're not happy, and this is going to lead us into a recession, and it's going to make companies' profitability fall, their revenue fall, and guess what? You think the stock market has crashed so far? Well, we could have much more to go. Because like I said, look at this. Household debt nears 16 trillion despite rising interest rates and inflation. And the reason I think this is happening is because people are having to use their credit cards to keep up with these rising costs. They're probably having to fill up gas with their credit card. They're probably having to buy groceries with their credit card. But unfortunately, the things with credit card and debt, eventually you get maxed out. And we've seen the government take on mountains of debt. And when this crash comes, the reason why I think it's going to be much, much worse than 2008 is because this time we have high inflation and the central banks aren't going to be there to save the day. They're not going to be able to stop the crash. They're not going to be able to reverse course. They're not going to be able to do these bailouts. They're not going to be able to drop interest rates to zero and print heaps and heaps of money like what they could do during the dot-com crash in 2008. It's just going to keep falling more and more, and it may not recover for decades. Remember, after the Great Depression, it didn't recover for 25 years. After the crash in 1968, again, it didn't recover for over 20 years. So people that have been investing over the past 10, 20 years have been very spoiled. We've had an unprecedented boom, but people, all good times eventually come to an end. And I think we could be facing a stagflationary crash or a slow decline for years to come. Because look at this. This is the reason why the Fed isn't going to be there to save the day. Inflation rose to 8.6% in May, the highest since 1981. Now remember, they've changed the way they record inflation in the 80s. So this is actually the highest inflation in real terms since World War II. Now, what happened with the inflation data is it's actually accelerating. Everybody thought that inflation peaked. They thought it would start to come down, but it's actually getting worse. The CPI for May, it increased at a pace of 1%. So when you annualize that, that is over 12% when you compound it. So inflation is actually getting worse. So what this means is the Federal Reserve should actually be getting much more aggressive. We've got nearly 10% inflation and the federal funds rate is only at 0.75%. People, they are very, very far behind the curve. And really what they should be doing is 1% interest rate hikes. And I wouldn't be surprised if they did do 1% interest rate hikes. And this whole thing saying, look, we'll just have to go a bit above neutral, maybe 3%, that should stop this inflation. That is a complete joke, people. Never, never listen to a central banker. They are liars. They have to speak up the markets. They have to tell you everything's positive. Remember last year they were saying, don't worry, there'll be no rate hikes till 2023. Then at the start of the year, they said, don't worry, there'll only be 3 rate hikes. Well, you know what they had to do last time to get inflation under control in the 70s? They had to lift interest rates above the inflation rate. So this means if the Federal Reserve is going to get serious, they're going to have to lift interest rates above 9%. And if they do that, this is going to cause a Great Depression, people. This is not me being doom and gloom. this is me being serious, and this is why I've been in a dark place for 3 weeks, and why I haven't really wanted to make a video, because it doesn't bring me pleasure to say this, but I've been, going down a rabbit hole, doing more and more research and studying history, studying past cycles, and we've been in this big boom. And you can also look what's happened. The fourth turning predicts that over the next 4 years, we're going to be in some very, very tough times. What I'm seeing with global governments, what I'm seeing with our political leaders right now are a complete joke. They are not leaders at all. They complete sellouts, people losing faith in the government. We're seeing other countries, the East, getting stronger. We're seeing authoritarian regimes getting stronger, more aggressive, and we're seeing the West decline, and we're seeing, morals in the West decline. And really, the market crash could be the least of our worries. Imagine the chaos of what's going on with Ukraine at your doorstep. Imagine the hyperinflation of Venezuela at your doorstep. Imagine both of those things happening at once and happening here in the West. People, I don't want to imagine that, but with the way things are going, with the way things are escalating around the world, with the way we're getting more and more confrontational with these other countries, it is not out of the realm of possibilities. And with the way they're handling inflation, with what I think, if we do get into a global conflict and they have to start printing more and more money and we have a melt up, we could see hyperinflation like what we're seeing in these other countries. Yes, it may not be as bad as Venezuela, but we're already seeing it, and it's only going to take another 50% increase in prices for people to be pushed over the edge and not be able to afford food, not be able to afford gas, and not be able to afford housing. So people, what this means in simple terms is I do not see anything bullish at all right now. All I see is completely bear signals. I don't see any hope for the markets right now. The Federal Reserve is going to have to lift interest rates higher. And because inflation is so high, it's not going to be like these other crashes where it's rebounded a year or two later. I think we're going to have stagflation like the 70s, and I think the markets are going to continue to decline. And I would not be surprised if the S&P falls 30 to 35%. That's what I'm seeing with the new data. Again, I change my predictions based on the data that comes out, because things do change very quickly in the markets. But I have been warning that I think things are going to get worse. Again, I think Bitcoin could fall below 20,000, and I've been hoarding cash on the sidelines. I've been telling you to prepare for these bigger deals. Yes, we're going to have bear market rallies. There's never a bear market where it's just a straight decline to the bottom. You're going to see volatility. You're going to see rallies. But people, these are traps. Again, there is nothing bullish. I don't see any hope for the markets, and I think things are going to get much, much worse. And again, we're going to see other crises besides the stock market crashing, like what's happening with the cost of living crisis, and like what's happening with these geopolitical issues that are going on, which I think could get much, much worse. There's still so much I want to go over. There's still so much things to get into more in depth, but the video will be far, far too long. But don't worry, I will start doing more frequent updates again. I have been in a dark mental space over the past 3 weeks, but I'm back, feeling good. It is good to be back. And don't worry, I'll keep you updated with the things that are happening in the markets. Thanks for watching. Thanks for your support. And I'll see you all in the next video.